Hello students, I am Shashi, Professor GBO Degree College in PG courses. So in our previous class, we discussed about the basic terms related to our subject. What is security analysis, what is portfolio and what is portfolio management. Today I am going to deliver a lecture on concept of investment. Here, concept of investment. What is investment? Investment is the employment of funds on assets with the aim of earning income or capital appreciation. Investment means employment of funds on assets with the aim of earning income or capital appreciation. Here, investment is an activity that is engaged by people who have savings. Here, that is, investments are made from savings, or in other words, people invest their savings, but all these savers are not investors. So investment is an activity which is different from saving. Here saving means saving is setting aside money, so you don't spend now. So you saving your money for emergencies or for a future purchase. But in investment is putting money into something with the expectation of profit. That means investment is buying assets such as stocks, bonds, mutual funds or real estate with the expectation that your investment will make money for you. Here, investment means employment of funds means you can invest your savings on assets, so with the aim of earning income or capital appreciation. Here capital appreciation means increase the value of an asset or investment over time. That means capital appreciation means difference between current price or market price and its purchase price. For example, if an investor buys a stock for 100 rupees for equity share. So, if an investor buys a stock for 100 rupees per equity share, so and the market price rises to 120 rupees. So if an investor buys a stock for 100 rupees, the market price rises to 120 rupees. That means there is a capital appreciation of 20 rupees per equity share. So the capital appreciation will result in a capital gain 20 rupees per share in case of the share is sold. Let us see our definition. Here we can define investment as the process of sacrificing something now for the prospect of gaining something later. So our definition entails three dimensions of an investment. So here one is the time, and second one is today's sacrifice, and third one is prospective gaining. Here if we invest our money in assets, we can get return in the future. That means there is time factor involved in the investment to get return in the future. So if we can invest our funds in present, but we can get returns in the future. That means there is a time factor involved to get the returns on investment. And next one is today's sacrifice. That means today we can invest some money in an assets. That means today present consumption is sacrificed. That means today we can invest some money. And third one is prospective gaining. Here prospective gaining means what is the aim of our investment? To get returns in the future. So what is the aim of our investment? Earning income or capital appreciation. These are the three dimensions of our investment. Let us have an overlook on the financial and economic meaning of investment. So, in the financial sense, the investment means investment is the commitment of a person's funds to derive future income. Here, in the financial sense, investment means investment is the commitment of funds, a person's funds to derive future income. That means the investor invests his funds in the to get the return in the form of interest, dividend, premiums, pension benefits or appreciation in the value of their capital. So, purchasing of shares, debentures, post office saving certificates, insurance policies are all investments in financial sense. So, such investment generate financial assets. That means in financial sense, the investor invests their funds on assets such as shares, debentures, bonds, post office saving certificates, insurance policies. So to get returns in the form of interest, dividends, premiums, pension benefits or appreciation. But in the economic sense, investment means the net addition to the capital stock of the society, which consists of goods and services that are used in the production of other goods and services. That means in the economic sense, the investments used to relation to the society and country development. In the economic sense, investment means the net addition to the capital stock of the society, which consists of goods and services that are used in the production of another goods and services. So, investment in this sense implies the formulation of new and productive capital in the form of new constructions, plants, buildings, machinery, inventories, etc. Such investment generate physical assets. The two types of investments are, however, related and dependent. So, the money invested in financial assets, the money invested in financial investments are ultimately converted into physical assets. So, the investments in the financial investments are ultimately converted into physical assets. Thus, all investments result in acquisition of some assets, either financial or physical. Next, what are the characteristics of investment? Here, the characteristics of investment are return, risk, safety and liquidity. So, let us see what is return. So, return means the investments made with the primary objective of deriving a return. So, the investor's main objective is to get the returns. So, the returns may be received in the form of yield plus capital appreciation. Here, what is capital appreciation? Capital appreciation means the difference between the sale price and purchase price. Here, what is yield? Here, yield means the periodical incomes. That means the dividend or interest received from the investment is called yield. So, the return from an investment depend upon the nature of investment. So, the return from investment depends upon the nature of investment, the maturity period and host of other factors. And next one is the risk. So, risk is inherent in any investment. This risk may relate to loss of capital, delay in repayment of capital, non-payment of interest or variability of return. While some investments like government securities and bank deposits are almost riskless. So other are more risky. So the risk of an investment depends on the longer the maturity period, the larger is the risk. So the lower the credit worthiness of the borrower, the higher is the risk. So the risk varies with the nature of the investment. Suppose investment in ownership securities. What are the ownership securities? That means equity shares. So equity shares carry higher risk compared to investment in debt securities. So like debentures and bonds. So equity shares carry higher risk compared to investment in debt securities. So what are the examples of the debt instruments? Debentures, bonds, etc. So risk and return of an investment are related. Normally, higher the risk, the higher is the return. And the third one is safety. Here safety means the safety of an investment entails the certainty of return of capital without loss of money or time. So that means in the safety of investment, we can get the returns, of capital without loss of money or without loss of time. The next one is the liquidity. So liquidity means, here what is liquidity? Liquidity means easily converted into cash. Liquidity means easily converted into cash. Some investment instruments like company deposits, bank deposits, etc. these are all not marketable. Preference shares and debentures are marketable, but there is no bias in many cases and hence their liquidity is negligible. So in the equity shares of companies listed on stock exchanges are easily marketable through the stock exchanges. So an investor generally prefers liquidity for his investments, safety of his funds, a good return with minimum risk, or minimization of risk and maximization of return. So these are the characteristics of investment. Okay, thank you.